Today's topic of discussion is investing in volatile markets. This last 3 to 4 year period has been extremely volatile for the share market, and it has had a myriad of reasons, be it the confidence crisis in the debt market or be it COVID-19 and absolute liquidity crunch. Now, to understand where to invest in a volatile market, I will highlight a small example. In case there was an investor who had invested 100 rupees into an equity fund. Let's say a year into the investment, the markets have been rising significantly and his investment has reached 200 rupees as a current value. But now a significant correction in the market takes place of about, let's say, 30%. This means there will be an erosion of the current value of rupees 60, which will leave us with a remainder of 140 rupees. This simple example very easily highlights how portfolio rebalancing needs to take place and understanding timing the market. Over here, the investor would have realized that the growth rate would have been significant on the principal amount invested, but at the time it reached its peak, one did not understand whether to book profits or to continue in the same manner. Therefore, mutual funds and experts have come up with a solution to this problem, and this is in the form of something called balanced advantage funds. Balanced advantage funds have gained popularity recently, and the volatility in the market is primarily the reason why. The way these funds work is that they invest into 3 major asset classes. First being equity, second debt, and the third is arbitrage. Arbitrage also comes under the main head of equity, and therefore this fund is traditionally taxed as an equity fund because majority of the asset allocation remains in the equity portion. Balanced advantage funds are dynamic in nature. To explain this statement, I will take a small example that balanced advantage funds have the ability to rebalance their internal asset allocation between debt and equity to the extent from debt funds can range from as low as 30% and go as high as 70%, and likewise for equity. The example to highlight this is that in 2017, when the markets were extremely low and there had been a significant correction, the balanced advantage funds had an equity allocation of up to 65 to 70%. But currently, when market levels have reached its peak, the equity portion of balanced advantage funds is something as low as 30% currently and 70% into debt. The reason we say these are dynamic is because these funds are very system driven by certain ratios like price to book ratio, price to equity ratio, and these are very formula driven funds. So as market levels keep changing, as we know they are dynamic, the fund keeps rebalancing its allocation accordingly. These types of funds pose advantages in 2 manners. Number 1 is the tax efficiency that was previously mentioned, as the equity and arbitrage element of the portfolio allocation allows this fund to be taxed under the equity side, which means that there is a tax efficiency and a lower rate of tax for these funds. And number 2 is that an investor can simply invest into these funds and not have to worry for the long term, because the rebalancing that is generally done manually is being done within the fund itself. So there are no redemptions or reinvestments. The rebalancing simply takes place within the fund itself, and it is being done by very well trained and experienced fund managers, which would definitely be a better option than an individual investor. So to conclude, if one is a passive investor and is not very frequent with the portfolio adjustments and reviewing, one should definitely consider balanced advantage funds because we leave the rebalancing of the portfolio and the growth to the experts.